Hello and welcome to this very special interview. Joining me today is one of India's sharpest personal finance minds, Feroze Azeez, who's the Deputy CEO at Anand Rathi Wealth Management. Someone you've been following, all of you, for a very long time. And it's wonderful, Feroze, to have you here on the Money Mile. You know, we saw when it came to debt, we saw a few accidents, in the last few months. And suddenly people began to talk about the risks involved in investing in debt mutual funds. All along it used to be equity is risky, debt does not come with any risk or with very low risk. And then we saw these few accidents along the way. What is the kind of risk that an investor must understand when you're investing in a debt mutual fund?
If you ask me, Vivek Sahab, the experience of debt over the last couple of years, especially from 2018, September, if I'm not wrong, when one of these AAA, almost considered quasi-government entities, went bankrupt. First conclusion or learning to be derived out of this accident, which was a series of accidents of 5-6 of them in the Indian economy, conclude that AAA is not good enough a reason for you to invest. Because out of these 6, which I'm choosing not to name, 5 of them were AAA a few years back when the bonds were bought by the mutual fund fund managers. So don't conclude that AAA is safe just because you've had an accident in AAA. That's a very counterintuitive conclusion to derive from the data thrown up so far. Second, also realize that this debt crisis has recently been in a category called credit risk funds and a spillover in corporate bond funds, largely. This, to my mind, was not even a credit risk event. It was more of a liquidity risk fructifying. Because of the risk aversion of people due to this surprise of a pandemic, risk aversion brought in illiquidity in several instruments. It has not been in the last 4 months that several bonds have defaulted. It's the perception of a default which has created illiquidity which has caused this problem. If you understand the distinction between a credit risk fructifying and a liquidity risk fructifying, your actions emanating from that understanding would be in the right direction. This is why I'm clarifying the foundation of your strategy in debt going forward. So liquidity, to my mind, in your debt portfolio becomes far more paramount than just credit risk going forward. So we at Anand Rathi, in the way back in March, had given a very strong exit call on credit risk funds, which we were a very strong proponent as well of, to be admitting that. But lock, stock, barrel, we sold our credit risk funds for our clients worth thousands of crores in the month of March and first week of April, because we saw this liquidity risk coming to hit us because of the general risk aversion which was creeping in. Now then we stuck to the course of overnight funds for 2-3 months for dust to settle, the government borrowing programs to be more clear, especially during pandemic. You can't envisage what kind of fiscal deficits you could have, and that can have a collateral borrowing requirement from the government. Now, currently, we recommend 4 different categories of debt funds, almost 1 in each. Dynamic bond funds are a good place for you to park your money because it has a lot of government securities in it and some PSUs also. Short-term debt funds are a good debt strategy, medium-term fund, and to a certain extent, if you look at banking and PSU bond funds. These 4 categories, if you restrict it for the next 1 year, till the dust settles even further, would be a good diversified strategy for you, rather than venturing into something where liquidity risk can come back knocking on the door.
It's been a pleasure talking to you, Feroze. Thank you very much and wish you all the very best. These are difficult times. You're doing a lot of good, hard work, advising and hand-holding your customers. So wish you all the very best. Thank you very much for joining me.
Thank you, Vivek. Bye.